Good morning, dears, and welcome to Super Coaching for UPSC by Textbook. And I am Pradeep, your economy mentor. And today we meet here to discuss one of the very important topic of Indian economy, that is foreign investment. So first, let me tell you that what is meaning of foreign investment. Foreign investment involves the transfer of funds from the foreign country. That means if the transfer of funds are taking place in the host country from the foreign country, it is going to be considered as foreign investment. And this foreign investment can be in two categories. One is known as foreign direct investment, other is known as foreign portfolio investment. So this foreign investment can be under two categories. One is foreign direct investment, other is foreign portfolio investment. So today we will try to understand that what is foreign direct investment and what is foreign portfolio investment, and what are the differences between FDI and FPI, and at the same time we will also understood that what is the advantages of FDI and what are the disadvantages of FDI in host country. So let's start our today's session, and it is very important. At the same time it is very interesting as well. So please be attentive because it is little conceptual. So let's start our session. So when we talk about FDI, so be very clear that when we are talking about investment, we are going to define investment from the investor point of view. So host country, here in the definition, the host country we will consider as foreign country. Host country we will consider as foreign country, okay, because we are defining FDI, foreign direct investment, from investor point of view. Investor point of view, suppose A is an investor and Z is the country, so we are going to define it from A's perspective. So what is FDI? Let me define it. FDI is an investment through which investor acquires or establish a business entity in foreign country along with management control. So as I said that we are defining FDI from investor point of view. So that's why we are considering host country as a foreign country. Host country as a foreign country. So suppose A is going to invest in Z, suppose India, or we can say that Reliance is going to invest in USA. So USA is going to be, Z is USA, and for that means a citizen of USA, India is foreign country, okay. So we are defining investment from the investor point of view. That's why we are considering host country as foreign country. So I am going to repeat once again, what is FDI? That means first we will try to understand it in layman words, then we will focus on the IMF definition. And because of that only we constituted Arvind Bayaram committee in 2014, and we adopted definition of FDI as per the international conventions. But before that, let me define it from layman perspective. So what is FDI, or foreign direct investment? That means it is an investment through which investor is going to acquire or going to establish a business entity in the foreign country with management control, okay. So that means individual is going to establish a plant or going to have the management control, okay. So that is considered as foreign investment. Okay. So since the individual is going to have the management control, so definitely that individual is having the affiliation with that country, with that entity, business entity. Okay, because that individual, that company belongs to individual. Okay, so that is the meaning of foreign direct investment. When we define the foreign direct investment in terms of IMF defines foreign investment as an investment through which an investor acquires substantial and lasting that investment through which investor acquires lasting and substantial management control. That means, and at least 10% in the foreign affiliate. That as per IMF definition, if any individual is going to acquire that substantial, that is at least 10%, 10% shareholding in the business entity with voting right, that will be considered as FDI. That will be considered as FDI. Okay, because let me explain you people that why there was. Okay, and because our definition was little different from the definition of IMF or international convention, therefore in 2014 Government of India constituted a committee that is known as Arvind Mayaram Committee. Arvind Mayaram Committee. He was the then secretary. He was the then Secretary of Financial Affairs. Okay, so that means under the chairmanship of Arvind Mayaram, we constituted a committee, and that committee refined the definition of FDI in case of India, and it was as per the international convention. It is as per the international conventions. So what is the definition and why we? Because IMF say that if you have 10%, more than 10% equity shareholding in foreign affiliate, it will be considered as FDI. But in case of India, we allow FDI. That what is the limits of FDI? Let me explain. Then only you will be in position to appreciate it or to conceptualize it. My dears, when we allow FDI in case of India, that FDI limits in India is that 0%. That means they are the most strategic. We are not allowing any foreign investment like atomic energy. Okay, either we are allowing 26% of that means FDI in our companies, or we are allowing 49% of FDI in our countries. At the same time, we are also allowing 51% FDI. At the same time, we are also allowing 74% of FDI in our companies, and we are allowing 100% FDI. Okay, in certain companies or in some companies, we are also allowing 100% FDI. We are allowing 100% FDI, and what is significance and what is importance, we will discuss in the form of advantages. But I just want to clear that why we reformed our definition as per the international conventions. What is the scenario in case of India for foreign investment, foreign direct investment? That either we are allowing 0% FDI, that means we are not allowing any FDI, foreign management control or foreign affiliate, or we are allowing 26%, or we are allowing 49%, or we are allowing 51%, or we are allowing 74%, or we are allowing 100%. So what is the scenario? And as per the IMF definition, any investment more than 10% in the foreign affiliate should be considered as FDI. And in our case, at least it should be 26%. Only it will be considered as FDI in case of India, because there is no limit like 10%. That's why in 2014 that government constituted a committee under the chairmanship of Arvind Mayaram, and he refined the definition, and as per that definition of Arvind Mayaram committee, any investment, please dears, try to understand, any investment more than 10%, in listed companies should be considered as FDI, and any investment, be it 1%, 2% or whatever it may be, any investment in unlisted company should be considered as FDI. Let me repeat it once again. What I said, that in 2014 we constituted a committee that is known as Arvind Mayaram committee, and it was just to refine the definition of FDI as per the international conventions. And as per Arvind Mayaram committee recommendation, we adopted those recommendations also. So nowadays, that as per that committee recommendation, any investment in listed companies more than 10%, any investment more than 10% in listed companies should be considered as FDI, whereas any investment, okay, by the foreign investor in unlisted company should be considered as FDI. So the keyword is listed company and unlisted company. Listed company and unlisted company. Listed companies are those companies which has devolved their shareholding, and they have raised the funds from the market. Those are known as listed company. We discussed capital financial structure or financial market. In that financial market, we discussed that capital market, money market and capital market. Under the capital market, we further divided it into the primary market and secondary market. Primary market is the market in which the first time company devolved their shareholding. So listed companies are those companies which has devolved their shareholding in the primary market. That means they have raised the funds from the market, from the general public. They have raised the funds from general public either in the form of IPO or in the form of FPO or in the form of private placement. Okay, so that means listed company means they are listed with the SEBI and they have raised the funds from the market or from the general public by issuing, by devolving their shareholding in the primary market, that is listed companies. Okay, so any investment more than 10% in listed companies should be considered as FDI, and any investment, be it 1%, 2%, 3% or less than 10% or 40%, 50%, whatever it may be, in unlisted company should be considered as FDI. So what is unlisted company? Unlisted company means they are not listed in stock exchange and they have not raised up funds from the public. That means they have not devolved their shareholding to the public and they have not raised a single coin from the market, meaning whatever investment is there in the company, it is the promoter's investment. That is unlisted company. So whatever amount is going to be invested in those unlisted companies by the foreign investor, that should be considered as FDI. That is the international convention, and we adopted this definition as per Arvind Mayaram committee recommendation. So I think it is very clear that why we adopted this, because in our case the FDI limit is 0%, 26%, 49%, 51%, 74% or 100%. So that means before this definition, that means we were considering FDI only when it was more than 26%. And as per international conventions, that any investment more than 10% with the management control should be considered as FDI. That's why we reformed and now we adopted new definition. So this is as per the recommendation of Arvind Mayaram committee, and I think it is crystal clear. Now we are going to proceed further and we are going to discuss that components of FDI, that how FDI is going to take place in India. FDI took place in India from MNCs, through MNCs. That means FDI comes through MNCs. MNCs, multinational companies. So MNCs are the source of FDI. MNCs are source of FDI. So MNC means those companies which have their business interest in more than 2 countries. Any company which has business interest more than 2 countries are known as MNCs. And these MNCs are source of FDI. In any country, MNCs are the source of FDI. So what are going to be components of FDI? We are going to focus on that. So what is going to be components? One is the foreign equity investment. So like whatever I said, that if suppose IBM is going to invest in India 10%, so that means in suppose Infosys, that IBM is going to invest 10% in Infosys. Okay, so 10% in Infosys, so 90% or whatever it going to belong to Infosys, and 10% management control is going to belong to IBM. Okay, so this is the meaning of equity investment. That means they have invested in the primary market, IPO or FPO. So that is equity investment is there, that whatever they are going to invest. Second is retained earning of the foreign companies. So what is going to be component? Very first component is whatever foreign investor is going to invest whatever amount, if it is more than 10% in listed company, that will be considered as equity investment. That means with that equity investment, the investor gets the management control up in proportion to their investment. Okay, that means if they invested 10% in the equity shares, then they will get the 10% voting right or 10% management control. That is the meaning of equity investment. Second is retained earning of foreign companies, and we will try to understand it. What is the meaning of retained earning of foreign companies? We will understood that what is the meaning of retained earning. What happened that I discussed it that when we were discussing taxation, I discussed with the you people CIT, corporate income tax, that the companies has to pay interest on their income. Companies has to pay tax on their income, that is known as corporate income tax. And what is income for the company? Income is nothing but profit for the company. Profit of the company is nothing but income for the company, and whatever profit the company earns, on that company is entitled to or has the liability to pay the taxes, that is known as corporate income tax. So suppose the company has we are going to understood that what is meaning of retained earning. Suppose company earned profit of 10 lakh. Company earned the profit of 10 lakh. So that means suppose 20% is the corporate income tax rate. So on their income, that 10 lakh, they have to pay 20%. So that means suppose 2 lakh they pays as CIT, that and 5 lakh. That means in the board meeting, company decided that we are going to distribute 5 lakh from our profit as a dividend. What is the meaning of dividend? It may be little bit tricky. Let me explain. Let me explain once again what I said, that suppose company earned 10 lakh as a profit, and that profit is nothing but the income of the company. Therefore, on that income, company has the liability to pay taxes. Suppose corporate income tax is 20%. So on that 10 lakh, company has to pay corporate income tax at the rate of 20%. That's why company has to pay 2 lakh rupees as a corporate income tax. What is remaining? Remaining is 8 lakh rupees. That company has 8 lakh rupees more with itself. Now, in the board meeting, company decides that we are going to distribute out of 8 lakh rupees, we are going to distribute 5 lakh rupees to their equity shareholding. Okay, that means what is the meaning of dividend? I just want to explain that equity shareholders, that means equity shareholders are those shareholders who has the ownership right on the company in proportion to their investment. Equity shareholders are those investors who has ownership right in the company in proportion to their shareholding. What is, and when company decide to distribute that a certain percentage of their profit to among their equity shareholders in proportion to their investment, that is known as dividend. That is known as dividend. Okay, that what returns equity shareholders are supposed to get from the company? The equity shareholders are supposed to get the returns in the form of dividend, and that dividend is distributed only when in the board meeting it is decided that company is going to distribute dividend. Okay, then only they are entitled to get dividend. And what is dividend? Dividend is that the equity shareholders, the returns of equity shareholders which they gets in proportion to their shareholding in the profit of the company, that is known as dividend. So suppose 5 lakh they decided to distribute among the equity shareholders. So how much investment, that means expenditure is going to be 5 lakhs plus 5 lakh as a dividend and 2 lakh as a corporate income tax. So that means company already invested or expend, that means 7 lakh rupees. Company already has expenditure of 7 lakh, and what is the profit of company? The profit of company was 10 lakh rupees. So how much is remaining? 3 lakh. If company decides to reinvest this 3 lakh rupees, and it is a foreign company, it is a MNC or foreign company, then this 3 lakh should also be in next financial year, this 3 lakh should also be considered as FDI. This 3 lakhs should also be considered as FDI. That is the meaning of retained earning. That is the meaning of retained earning of foreign companies. That is the meaning of retained earning of foreign companies. That whatever percentage or whatever amount companies are going to invest from their profit in next financial year, that should also be considered as component of foreign direct investment. So one is equity shareholding, other is retained earning of the companies, next is intra-company debt transfer. Intra-company debt transfer, we will understood, don't worry what is the meaning of it, and that's why I explained this. I made this so that it must be very clear. Let me, what is the other component of FDI? Other component is intra-company debt transfer. Intra-company means within company. Okay, so what is going to be that, as I said, that source of FDI is always MNCs. Source of FDI is always a MNCs. Let me, so it will be source of FDI is always MNCs, and whenever any MNCs is going to open, it can be opened either in the form of branches. We will understood what is the meaning of it. It can be opened either in the form of subsidiaries, or it can be opened in the form of joint venture of 2 or more companies. That, as I said, that the source of FDI in any country is always MNCs, multinational companies. And what is the meaning of multinational companies? The meaning of multinational companies is any company which has the business interest more than 2 countries is known as MNCs. So this MNCs are the source of FDI in any country, and this MNCs can be opened in 3 forms. That MNCs can be opened in the form of branches, MNC can be opened, MNC can open their subsidiaries, or MNC can that establish a joint venture. MNC can establish a joint venture. This can only be the that establishment, source of establishment or idea of establishment of MNC. What is the branch? What is the meaning of branch? Branch means whatever business interest the parent company has, that is same, they are going to open their plant in same interest. Okay, suppose IBM, I am going to give example of IBM only. IBM is that a software industry, they deals in software. So that means IBM is a USA company, and in India we have IBM India, and they are also dealing in software industry only. So that means what is the parent company interest? That is software only. So in other country, that means in foreign country, if they are going to establish a business entity, they are going to have the business interest in the same industry only, that is software only. Then it will be considered as branch. Okay, next, other can be subsidiary. What is the meaning of subsidiary? We are going to take example same. Suppose IBM has the business interest in software, as I said, and it is USA company. Okay, and this IBM is going to open or going to have the interest in textile. They are going to open a plant related to textile industry. Okay, so the parent company business interest was in software, but they are going to expand their business interest in the host country or in foreign country in some other sectors, that is known as subsidiary. Okay, next can be joint venture. Other source or other establishment of MNCs can be joint venture. That means 2 MNCs can come together and they can establish a business entity in the foreign country, or one company of host country and other company of foreign countries can come together and they can establish a joint venture, and they can make a joint venture and they can establish a be the subsidiary or branch, whatever it may be. So that is known as joint venture. Joint venture. That is known as joint venture. Like earlier it used to be Hero and Honda. That was the joint venture of Indian company Hero and Honda, foreign company Honda. Okay, so that means, and that is the meaning of how they open their branch. What is the meaning of intra-company debt transfer? The meaning of intra-company debt transfer is, suppose MNC, let me rub it first, then I will explain. What is the meaning? Okay, other source or other component of foreign direct investment can be intra-company debt transfer. What is the meaning of this? We will understood it now. What is the meaning? The meaning is that suppose this IBM India is the software company and they opened a subsidiary in the name of IBM Textile, IBM India Textile. Okay, and this deals with the textile industry. So this is going to be subsidiary. So if this subsidiary company, that is IBM India Textile, needs any fund, needs the funds, they are in loss or they needs fund for the that upgradation of their business, for the technology upgradation, whatever it may be, for that means for expanding their plant. Suppose IBM India Textile needs the fund. Okay, so whatever, if these funds are going to be, transferred from IBM India to its subsidiary, that will be considered as intra-company debt transfer. That will be considered as intra-company debt transfer. Or even if IBM is transferring, IBM, that is USA company, is transferring any fund to their IBM India, that would also be considered as intra-company debt transfer. That is the, so the source of or component of FDI can be foreign equity investment, other can be retained earning of the foreign companies, other can be intra-company debt transfer. So these are three components of FDI. That FDI always comes in three form, either it is in the equity shareholding or it is intra-company debt transfer, or it is in the form of retained earning of the foreign company if it is going to be invested again. So these are the components. Now we are going to focus and we are going to discuss foreign portfolio investment. Okay, as I said that foreign investment can be in two forms. We discussed when we started our discussion, we started with it only, that foreign investment, this foreign investment can be in two forms, either it is in the form of FDI or it is in the form of FPI, foreign direct investment or foreign portfolio investment. Is it okay, dears? Is it okay? So this can be, foreign investment can be in two forms, either in form of FDI or in the form of FPI, foreign portfolio. So we discussed FDI, now we are going to focus on FPI, foreign portfolio investment. What is the meaning of foreign portfolio investment? That it is an investment in which an investor purchases a security from the foreign financial market. Okay, that means that here we are considering host country as foreign country. That means investor is going to purchase the shares from the foreign financial market. That is known as foreign portfolio investment. That means they are not going to, okay, they are going to invest in the capital market, especially in secondary market. That means they are going to sell and purchase the already existing shares of the company. Okay, so that means they are just a investor, they are not a owner of the company, they are not going to have the management control of the company. That whereas in case of FDI, the FDI investor or when FDI investor, in a case of FDI, investor has the management control up to the proportion of their investment. But in case of FPI, the investor invest in the capital markets, especially in secondary capital market. That means the sale and purchase of already existing shares, they invest in those. That's why they do not have, in case of FPI, the investor do not have any management control or voting right. They do not have any management control or voting right. Not only this, they enjoy anonymous relation with company. That means they are not having the ownership right. That's why they enjoy the anonymous relation. They do not know. Okay, they do not have any emotional attachment with the company, because this company do not belongs to them, because they are just the investor. They are just selling and purchasing the shares of the company from the secondary market. Whereas in case of FDI, that investor is going to have the equity share, that means ownership of the company. So that individual has the ownership right on the company. Okay, so can we proceed further? So this is about the FPI. Now I think it is very clear that we will discuss the differences, and FDI is always considered to be good in comparison to FPI, foreign portfolio investment. Foreign direct investment is considered better. Janvi जायसवाल जी काफी लेट हो, यू आर टू लेट. Class starts at 8:30 dears. Please keep in mind that class starts at 8:30. Now again, so be regular, be punctual, be disciplined. And if there is any doubt, I am here to solve it. No issue, but try to be on time. Please dears, this is very humble request that be disciplined. So the thing is that we were discussing about the FDI and FPI, okay, and FDI is always considered to be better in comparison to FPI, foreign portfolio investment. Okay, we are the significant, or we are the highest receiver of the foreign investment. Okay, we are the that means highest receiver of foreign investment. That means we are getting the foreign investment, but most of the foreign investment in case of India is coming in the form of FPI rather than FDI, and we will discuss that what is the significance of FDI. What is the significance of FDI? FDI is always better in comparison to FPI, foreign portfolio investment. Because when FDI, it is going to come in FDI, that means they are going to establish a plant, they are going to establish a business entity. So they are not only coming with financial assets, but they are coming with management control, that management strategy, the market strategy. They are going to come with modern technology, better technology, that is going to improve our efficiency. At the same time, since they are establishing a plant, or they are establishing a business entity, so it is not easy for them to sold out it. Whereas in case of FPI, That means they can purchase shares and they can sold out shares whenever they want to. So that's why it is more volatile, whereas it is FDI is stable. So FDI is considered to be more better in comparison to FPI. We will discuss that why advantages as well, but the thing is I just want to give you an idea that what is the case, that FDI, that in case of FDI the investor is going to establish a plant. When investor is going to establish a plant, that means investor is not only coming with capital, undoubtedly that is financial resource, that is coming with financial resource, but not only financial resource, but that is going to come with modern technology, that is going to come with a market strategy, that is going to come with a better entrepreneurial skill, that is going to come with management skills, that is going to improve the efficiency of the country, that efficiency of business activity, that is going to reduce the cost of production in the host country, and that is going to make our product competitive in the international market, and that is going to boost our exports. So that's why FDI is always considered to be better in comparison to FPI, because it is more stable and it is not it is coming with lot many advantages. We will discuss it separately. But although India is highest receiver of foreign investment, but most of the investment is in the form of FPI rather than FDI. Okay, so that is the case. Now we are going to discuss, and we are going to discuss the differences between FDI and FPI. What are the differences? First difference we can do on the basis of definition only, that investment through which investor establish the business entity or acquires business entity in the foreign country, that is FDI. What is FPI? FPI, that means investment through which investors purchase the shares from the foreign financial market or stock market, especially in the secondary market. Okay, so this is the case of FDI. So that means that is going to be, and this is going to be FPI. Okay, on the basis of definition. Second, we can say that FDI inflows in the primary market. Okay, let me explain it. Although I explained it at least 4 or 5 times already, but I am going to explain it once again. When we talk about the financial market, let me explain it. Financial market, this financial market can be categorized under 2 categories on the basis of for how long the transfer of fund is taking place. That is, one is known as money market. We discussed when we were discussing financial system. One is known as money market, other is known as capital market. Other is known as capital market. Money market means that transfer of funds takes place for the shorter period, that is up to 1 year. Capital market means transfer of funds takes place for the longer period, that is longer period and medium term, that is 3 to 5 years and more than 5 years, that is capital market. And this capital market can further be divided under 2 categories. One is known as primary market. One is known as primary market, other is known as secondary market. One is known as primary market, other is known as secondary market. Okay, what is the meaning of primary market? That, as I said, that listed company, whenever any company is going to be listed, that means they are going to devolve their shareholding. They are going to devolve their shareholding to the public. So where they are going to devolve? They are going to devolve their shareholding by that means registering with SEBI, Okay, and the first time, if they are going to devolve their shareholding for the first time, and that target audience is public, general public, that may be that citizen of India, that may be foreigner citizen. That means they are going to target general public and they are first time issuing, that is known as IPO. If they already issued and they are again going to devolve their shareholding and they are going, suppose what is the meaning of shareholding? Just suppose this is ABC is the three individual who promoted a company XYZ Limited. They promoted, okay, that means in case of economics, we always use the word promoters for those pupils who have taken initiative to establish a business entity. We do not use the word owner, okay, we suppose to use word promoters. So the individual or the investor who started a company or who took initiative to start a business XYZ, they are known as promoters. Suppose this is 100%, that ABC, when they started, ABC started XYZ Limited, initially their holding was 100%. They were having 100% shareholding. Now they want to devolve, okay, they want to devolve 26%, because as per SEBI norms, at least, okay, leave it, that means they want to devolve 26% shareholding. Okay, if they want to devolve say 26% shareholding, earlier their shareholding was 100%, now their shareholding will be 74%. If they want to devolve 26%, they have to register with SEBI. They have to register with SEBI and they will target to the general public, and for that targeting general public they will issue IPO. That's why it is known as initial public offer. So where they will devolve their shareholding? They will devolve their shareholding. This whole capital market is going to be capital market, but they will devolve their shareholding only in the primary market. So whenever the company devolve their shareholding, they always devolve their shareholding in the primary market. That means they are going to reduce their shareholding. ABC individuals, promoters are going to reduce their shareholding from 100% to 74%. That means they devolve, and by devolving, that means they are selling their shareholding up to 26%, and by selling 26%, they are going to get the funds, and they are going to get the funds from general public, and that general public can be that Indian citizen and that can be foreigners. If it is foreigner, that will be considered as FDI. It will be considered as FDI. So FDI always inflows in the primary market. Let me rub it first. Now I think it is very clear that why we use the word promoters for the investor who took initiative and owners for all others. Because whosoever is investing to get 26%, they are also owners of the company. Okay, so whosoever is having the equity shares, they all are the owner of the company. But who took initiative to start a business, they are known as promoters. Or promoter. So this is clear. So now we are going to proceed further and we are going to discuss that this FDI always inflow in the primary market. I think it is very clear, crystal clear. And this FPI inflows in the secondary market. Secondary market, that means already once the company devolve their shareholding, whatever shares they devolve, that selling and purchasing of those shares are going to take place in secondary market. So when foreign investor is going to purchase the shareholders of the company from the secondary market, it will be considered as FPI. So FPI flows in secondary market, whereas FDI flows in primary market. I think it is very clear that in case of FDI, the investor is active investor, because that is going to establish a plant, that is going to have the management control, that is going to have ownership right on the company, whereas it is passive investor, because that is going to, in case of FPI, the investor is not enjoying any relation to the company. Okay, they are going to selling and purchasing the shares, that's why it is a passive investor. In case of FDI, there is high control, that means there is that policies for FDI in case of India. Okay, and you cannot come and go in case of FDI. Okay, that means FDI is not like that, that you can come with the investment and you can establish, and whenever you want to, you can that sold out. It is not like that. There is some conditions, and that's why there is high control in case of FDI, whereas there is very low control. That's why it is volatile. That's why there is flight of capital. Flight of capital in case of FPI. In case of FPI, there is flight of capital. That means they can purchase the shares from the secondary market and they can sold out the shares of company in the secondary market. That's why that whenever they want to sell sold out, they can sold out, and that is nothing but flight of capital. They can come with a financial capital and they can sold out and they can withdraw their financial capital. So that is volatile. Okay, so it is that when FDI is going to come, it is going to be long term, because they are going to establish a plant, and it is going to be short term. FPI is going to be short term. FDI is stable, it is very clear. When they are going to establish a plant, it will be stable, whereas it will be volatile, because as I said that there is flight of capital. Flight of capital means they can sold out their shareholding, that means shares, and they can withdraw their funds. That is volatile. Here in case of FDI, that investor invest in physical assets, that means equity shares. They are going to invest in equity shares. They are going to establish a plant. If they are going to establish a plant, that means that is physical assets, whereas FPI, they are going to invest in financial assets, shares from the secondary market. That's why financial, it is difficult, whereas it is very relatively easy. Okay, so this is about the differences. These are the differences between FDI and FPI. Now we are going to proceed further and we are going to discuss the advantages and disadvantages of FDI. Okay, let me explain it, then we are going to finish it. That is going to complete our lecture. So listen it very carefully. So when we talk about the advantages of FDI, as I said that they are going to come with financial resources. That means when the foreign investment is going to come, okay, and if it is in the form of FDI, that means they are going to come with capital. So this is going to supplement the existing capital in the host country. It is going to supplement capital. Whatever financial resources was there in the host country, it is going to add certain more resources, financial resources. When there will be more resources, that means it will increase our, that means we will be in position to produce more. When we will be in position to produce more, that means it will increase the one hand, it will increase the employment. That means it will increase the employment in the host country. Not only employment, it will also increase the that economic growth, more production, production is nothing, that means production capacity is nothing, increase in production capacity is nothing but economic growth. It will increase the economic growth, and that economic growth can be distributed equitably, so it can be converted to into economic development. So I am going to repeat once again, dears, please try to understand. When there is going to be FDI, that means they are going to come with financial resources. That means they are going, suppose they are going to come with 10 lakh crores, 10 lakh crores fund. Okay, and with that 10 lakh crore fund, they that means gets 14% of shareholding of any company, suppose XYZ. They got shareholding of 14% of XYZ. Okay, so whatever resources was there with the XYZ, okay, with that resources XYZ must be doing some business. Okay, if it is going to be more 10,000 crore, with that more 10,000 crore, they will definitely increase their production capacity. And in order to increase the production capacity, they have to employ more people. And when there will be increase in production capacity, that means it will lead to economic growth, because increase in production of goods and services is nothing but economic growth. When there will be economic growth, if it is going to be distributed equitably in the society, it can be known as economic development. So economic growth can be converted into economic development by the government. So this is, so when it comes with, when there is FDI, it comes with financial resources, or it supplements existing financial resources in the host country, which lead to growth in economic growth and economic development in the host country. Not only this, they comes with, okay, they introduce, when they are coming with funds, they are not going to come with funds only, they are going to come with better technology, they are going to come with better technology, they are going to come with management skills, better management skills, they are going to come with a market strategy, better market strategy. So that means, that is because of this, because they establish that belongs to them, they are going to have their company. If that is their company, they will definitely transfer technology, they will definitely transfer better management skill, they will definitely transfer better market strategy in the host country. So that will increase the efficiency of the economy, that will increase the efficiency of the economy. If efficiency will increase, the cost of production will reduce. When the cost of production will reduce, that means, let me rub it and make it clear. My dears, let me explain that when any foreign investor establish a plant, they come with better technology, better technology, better management skills, and advanced market strategy. Okay, when they come with it, that means it is going to increase the efficiency of the economy. When there is increase in efficiency of the economy, what will be, that will, it will reduce the cost of production, or market share. It will increase the market share, or it will reduce the cost of production. Because of that, our product will be competitive, product becomes competitive in international market. Because of that, it increases our exports. It increases our export. Because of that, our forex increases. Because of that, our BOP situation is strengthened. Okay, so that is the case, that when they are going to come, they are going to come with new technology, better skills and knowledge. Okay, market knowledge and entrepreneurial skills. Okay, so that is going to increase efficiency of the economy. Because of that, the cost of production is going to reduce, or market share of the company is going to increase. Because of that, our product will be competitive in the international market. That will increase our forex, and it will improve our BOP situation, balance of payment situation. I think it is very clear. Now we are going to proceed further, but before that, let me rub it. That other thing is that it creates the employment opportunity, and we already discussed that when there will be financial resources, it will increase the production capacity, and with the increase in production capacity, there will be more employment opportunity in the host country. Then we can say that it is going to create the better business environment, that competitive business environment. How it is? That means it is going to create better business environment. How it is going to be? Because that foreign companies are going to come with advanced technology. They are going to come with better management skills and better market strategy. So that domestic companies which has to sustain, if they want to sustain, they have to improve their technology. They have to improve their market strategy. They have to improve their entrepreneurial skill. Then only they can exist. Otherwise, they cannot have competition with that companies, with those MNCs. Okay, because they are with better technology, they are with market strategy. So that's why, that means the domestic companies forced to improve their efficiency in order to sustain in the market. In order to sustain in the market, it forced the domestic companies to improve their technology, to improve their entrepreneurial skill, to improve their market strategy, which will enhance the efficiency of the economy as such, which will reduce the cost of production, which will increase the competitiveness of our product. Again, our export will increase. So because of FDI, it is going to create better business environment in the host country, in form of technology, in form of management skills, in form of market strategy, etc., entrepreneurial skills, etc. So this is very clear. Okay, next, it enhances the quality of product and services. Since they are with the better technology, so that definitely they will that means produce better products, and they will give better services. Okay, and you people will be very much aware that what are the services given by the, if we took the example of banking sector, that means the services given by the private banking sector is altogether different from the services given by the public sector banks. Okay, so that's why they are better. Okay, they are going, which is going to increase the living standard in the host country, because they are producing better products. At the same time, they are giving better services, which is going to create demand for the better services, which is going to improve the living standard in the host country. Not only this will promote the industrial diversification in the host country. How it will improve the industrial diversification? That they are coming with better technology. So earlier it may be that we may not have the technology for textile production, but when we are going to have MNCs, that MNC is going to be established, they may have the technology, so it may improve our diversification. It will diversify our industrial base. Not only this, it promotes the industrial development in the host country. How it is going to improve? Let me rub it, then I am going to. We have time. Okay, although our time is already left, but I am going to complete it. That I am going to complete this advantages and disadvantages. That it promotes the infrastructure development in a host country. How it is going to be that in the host country, that MNC is going to be established in only those areas which have the better physical infrastructure, which have better physical infrastructure. That MNCs are going to establish in those areas which have the better physical infrastructure, like road connectivity, like railway connectivity, etc. Not only this, that means there is requirement that there is an FDI policy. The government has that make a condition that in order to, if you want to invest in India as a FDI, you have to invest in in the infrastructure as well, or back chain. Back chain means in the infrastructure development. So either by having the demand of better infrastructure, FDI is going to take place, or either directly investing in the infrastructure, that is going to improve the infrastructure development in the host country. Not only this, it provides the significant tax revenue. FDI provides significant tax revenue to the host country. Significant tax revenue in the form of CIT. When there will be, that means company will be there, and if the because of financial resources its production is going to increase. If the production is going to increase, that means its profit is going to increase. If the profit is going to increase, that means it is going to increase the CIT. So the CIT is going to increase, that is going to increase the tax revenue for the government, which can be that means used for the betterment of society. So it provides the significant amount of tax revenue, because they are coming with financial resources. When they are coming with financial resources, that will improve the production, that will motivate, promote the production capacity of the economy, which will increase the profit of the company. As a result, liability of the company to pay CIT will also increase. As a result, tax revenue of the government will increase. I think it is very clear. Now we are going to discuss another point, that is it tend to reduce factor price differentials. What does it mean? Okay, it is very technical word. Is it like that? Okay, let me explain it. Okay, factor price differential. What is the meaning of it? Please try to understand. As I said that the production always takes place with the factor of production. Production always takes place with the factor of production, and there are four factor of production. One is land, other is labor, other is capital, and other is entrepreneurial skill. Entrepreneurial skill. So what happened that in the developed country, there is surplus of funds. There is surplus of funds. That's why when there is surplus of funds, rate of interest is comparatively, rate of interest is low. That means, and they are going to take the capital from their country at lower rate of interest. So when that much capital is going to be in the host country, so funds are going to be reduced in foreign country. When the funds will be reduced, rate of interest in the foreign country will increase. Let me explain once again, and please try to understand what I want to say. That suppose that investment is coming from the advanced country or developed country. So why the investment is coming from advanced country? Because they have surplus of fund. Okay, if they have surplus of fund, the rate of interest will be low in those country. Why it will be low? Because the rate of interest is decided on the availability of funds. Okay, if surplus of funds, demand, that means funds are more than demand, then rate of interest will be low. Okay, suppose they took the funds at lower rate of interest and they invested in host country, and there is high rate of interest because there is deficit of funds. So high rate of interest, but because there is capital, supplement of capital, so that's why, because there will again more funds will be there, that's why the rate of interest in host country will be lower. Okay, that means because of those funds there will be high rate of interest in foreign country and there will be low rate of interest in the host country. That is nothing but tend to reduce factor price differential. Similarly, that labor cost, we can talk about the labor cost, that in case of developing country the wages, labor cost or wages is comparatively low. Why? There is supply is more than demand, supply is more than demand of the labor, because we have demographic dividend, and when there is going to be the MNCs, that production is going to increase. When the production is going to increase, in order to produce more, they are going to make more demand for the labor. When there will be more demand for labor, what it will increase? It will, that means demand will increase and supply is constant, then the wages will increase. So it will increase the wages. Okay, so when there will be the foreign investment in host country, it will reduce the rate of interest in the host country and it will increase the wages for the labor force in the host country. That is nothing but price differentials, that is nothing but factor differentials. Okay, whereas it will increase the rate of interest in the foreign country and it will reduce the wages in the host country. That is the meaning. Okay, now we are going to proceed further and we are going to discuss disadvantages of FDI. Okay, and very first, okay, I am going to finish it in just 5 minutes because we do not have more time, so I am going to finish it. Okay, so first is it adversely affect the domestic companies. Okay, it adversely affect the domestic companies, especially MSMEs. Why MSMEs? Because MSMEs are labor intensive, and they are MNCs and they are coming with advanced technology. When they are going to come with the advanced technology, their efficiency, MSMEs efficiency will not be at par with MNCs. Okay, they will, that means they will be more competitive. MNCs will be more competitive because they are using advanced technology, whereas MSMEs cannot afford the advanced technology. That's why, and the MSMEs has to compete with MNCs. That's why they cannot compete with MNCs. MSMEs, medium, small, small medium enterprise cannot compete with MNCs because they have the advanced technology. That's why it will negatively affect the MSMEs or domestic companies. Okay, and it will again further worsen the employment rate because MSMEs is labor intensive, and when they will be negatively affected, the labor will become unemployed. So unemployment rate will again, because these MNCs are using capital intensive, they are making products with machines, not with labor, whereas MSMEs are, and they will negatively affect, because of that there will be unemployment. Okay, so that means this is very clear. Okay, so that means it will negatively affect the MSMEs, as because of negatively effect of MSMEs, it will negatively affect the employment rate, or it will further that means worsen the employment rate in the economy. Not only this, it will create the possibility for intervention in domestic economic policies. What it means? If I have the time, I can explain it more better, but let me explain that there was survey by IMF, International Monetary Fund, and they try to find out the top 100 economies of the world. That IMF tried to find out the 100 top economies of world, and you will be surprised to know that in those top 100 economies, 51 was MNCs and 49 was countries. That means the size of MNCs, the turnover of the MNCs is as large as the GDP of countries. GDP of countries. Okay, so they are very very big companies. So MNCs are very big companies and they are coming with FDI. So that means by giving a bribe of 0.00001% of their profit, they can tilt the policies, they can tilt the economic policies in their favor. Okay, and that is the meaning of, that means they can create the possibility of intervention in the domestic economic policy. Okay, we were that colonies for 200 years. Okay, and they came for the economic, that means economic profit only. Initially they came with economic profit only, but later they became the ruler ruler. Okay, so that can again be the possibility, because you can bribe the ministers and you can tilt the policies, economic policies in their favor, because they are very big large companies and they can give 200 crore or 300 crore bribe to the politicians. I am not saying that the politicians are corrupt in India, but there can be possibility. Okay, and they can tilt the policies in their favor. Okay, so that is the case, and that can be the case. Okay, so it creates the possibility for the intervention in the domestic economic policies by bribing to the ministers, and the minister can plead in their favor in the parliament. Okay, so that can be the issues. Other thing can be, it can worsen the income inequality and regional inequality. Income inequality because unemployment, because of that shutdown of MSMEs, unemployment because of shutdown of MSMEs, income inequality, whereas they are going to hire to the high skilled people, so their income is going to increase. So income inequality, regional disparity or regional inequality, because MNCs are going to be established only when they are going to establish plant where they have good infrastructure. So that they are going to have the establishment in Bengaluru, in NCR, they are going to in Mumbai, etc. That means they are not going to establish a plant in interior area. That's why there will be regional inequality as well. Okay. Other thing is, it induced the dualism. Dualism means sharp difference between the modern technology as well as traditional technology. We can take the example of metro. That means in Delhi, people are using metro as a commuting, for commuting, as well as there can be bullock cart as well. Okay, for commuting people are also using bullock cart. Okay, so that means that is nothing but dualism, sharp difference between the modern and traditional. Okay, so that means it creates the dualism in the, and not only this, it repatriate. Okay, that means FDI repatriate means send back, okay, to their host country, to their country, a huge forex in the form of dividend. We already explained dividend in the form of interest and in the form of royalty. That means dividend means whatever profit they earned, and they are equity shareholders, so they are entitled to get the share in the profit as per their shareholding. That is nothing but dividend. Not only this, they invested the capital, they come with capital, and then on that capital they are entitled to get remuneration in the form of interest. Not only this, they are coming with technology and they are using that technology, so they are entitled to get the royalty for that technology. So they are going to send back used money in the form of dividend, in the form of interest, in the form of royalty in their country. Okay, this is also the case, and it induced the consumerism. Okay, what is the meaning of consumerism? Okay, I am going to finish with this only. Let me explain it. That means it induced the consumerism in the host country. And what is the meaning of consumerism? Consumerism means consumption just for the sake of consumption. That means you do not need that product, but still you are going to use it, or you are going to that means make demand for it, and it is not good for the developing country. Let me explain it. What is the meaning of consumerism? Okay, it induced the consumerism in the domestic country, what, or host country. What is the meaning of consumerism? Consumption just for the sake of consumption. What is the meaning of it? Meaning of it is that you do not have the demand or need for that product, but still you are going to make demand for it. Okay, suppose you have that means whatever it may be, suppose you have uh, suppose you have 10 AC, okay, and still you are making demand for more ACs, although you do not need, but because of advertisement excessive advertisement, they make superficial differentiation in the product. Because of that, it makes the demand in the economy, which creates the consumerism. And consumerism means just for the sake of consumption. Because of that, what will be there, that in the host country, especially in developing country, consumerism is not good. Consumerism is not good. Why? Because when people are going to make demand, they have to spend, they have to make expenditure. When they will make expenditure, it will reduce the saving rate, it will reduce the saving rate in the economy. When it will reduce the saving rate, investment rate in the economy will reduce, investment rate in the economy will reduce. I am going to repeat once again that this FDI disadvantage, it induced the consumerism in the host country. Consumerism means consumption just for the sake of consumption. That means you do not need that product, but still you make demand for that product. When you are making demand for that product, that means you are going to make expenditure for that product. When you are going to make the expenditure for that product, that means your saving is going to reduce. When saving is going to reduce, the investment rate in the economy is going to reduce. When investment rate is going to reduce, it is going to reduce the capital formation. It is going to reduce the capital formation, and it is not good for the developing country, because in the developing country we need to have more investment rate, we need to have more capital formation in order to produce more. That's why consumerism is not considered to be good for the developing country. If there is any doubt, let me know. Otherwise, we are going to stop here. Thank you very much, dears. Thanks a lot. Is there any doubt? Let me know. And to get the PDF of this class, just join my Telegram group, Pradeep Sir Textbook. If there is any doubt, let me know. Can we stop here? Thank you very much, dears. We are going to stop here. Thank you.